Let's talk about capital gains tax as it relates to selling residential real estate. So first and foremost, I'm not a CPA. You should check with yours. Also check to make sure that things haven't changed since the making of this video. But for the most part, like I said, this is going to be kind of an overview. So the important thing to know is this. When you sell a home that you have lived in, right? So if you've lived in it for 2 of the last 5 years, then you can sell it and avoid capital gains up to $250,000 or 500,000 if there's 2 people in the home. So for example, if somebody buys a house for 500 grand, they've done nothing in terms of improvements. They just live there for 2 years and the house is then worth 600 grand. So it appreciated, let's say $100,000 in 2 years. That's not normal. That's certainly crazy. But let's just use that as an example. So in that instance, this person, whoever owns this home, if they live there for 2 years, if it's their homestead, they do not need to pay taxes on the $100,000 gain that they got from that home. So that is capital gains, and you avoid taxes on those capital gains when it is your homestead for 2 of the last 5 years. I have seen an instance, and a CPA confirmed this, that if somebody was made to relocate or something like that, to where the CPA, and again, this is one CPA's opinion, but I've seen it to where like they live there a year and a half. And basically the CPA says, okay, you got to pay some portion of that, but not the full amount of taxes on the 100 grand. So that's one person's opinion. He's a CPA. I'm not. This was many years ago, but that is how you avoid it. Down below, I'll put some basic, text in there about tax rates. If it's short term, it's owned, a property is owned less than 1 year, you pay short term, which is like ordinary income taxes. If you own it for over a year and you sell it, again, these are for investment properties or second homes, and you sell it, you then pay, it depends on your income levels, how much taxes, up to 20% taxes on those capital gains. So I'll put all that down below if you need it. But the important thing to know is if you live there for at least 2 years, and then you get to avoid those capital gains. Also, let's say that scenario I just took, if somebody lives there or doesn't live there, but it's a investment property for 500 grand. Let's just say that scenario. And it's now worth 600, but of that 600 value, maybe they put in $70,000 worth of improvements. And so really the actual gain was about 30 grand in actual like capital gains. So if they sell it for 600, bought it for 5, put in 70, that 30 grand profit is what they get taxed on. You have to then keep your receipts, show proof that you did spend the 70 grand. So that way you can present that to your CPA and only pay taxes on the 30,000 because your cost basis went from 500 to 570 after you, the investor, put in that additional improvement. So hopefully that answers the question. If not, feel free to reach out to the mortgage market team. We are certainly here to help. And as always, when you think mortgage, think Mark.